Episode 573, Trading Justice Podcast. Matt and Mark coming at you on a Sunday. Well, it's morning in your place, Matt. It's afternoon where I'm at, recording before the market futures get open, where we've had a moment to digest, where we've had a moment to release our newsletter. The Trading Justice Podcast brought to you by Tackle Trading, which we're obviously a part of. We have these two little worlds, Matt, our podcast world of Trading Justice and Tackle Trading. And I know I just love that you started both of these many years ago, and I get to be a part of them. But how are you doing on this Sunday, brother?
Doing good, excited to be here, and always excited to record another edition of the TJ podcast. And for those of you finding our podcast on YouTube, we did start putting that on just recently, a couple months back. Hopefully you guys are enjoying the visual edition of the podcast as well. But just a shout out to all of our listeners of the podcast. Love you guys. Hopefully you enjoy the ride with us.
Yeah, no, and whether you listen, whether you watch, whatever it may be, we try to bring you world-class, like genuinely world-class analysis. We put a lot. We like to get things dialed in. We like to get things right. We like to give you, the best perspectives that we possibly can, unbiased, because bias will not lead to profitable results. It is just that simple. Matt, we got a lot to talk about, but before we get going on that, I want to just highlight our not Trading Justice, our Tackle Trading newsletter. You have started beefing up this newsletter, and you've basically said, Mark, expect a little bit more work in the next little bit as we beef this up and make it just a destination type place. Talk about, just briefly, what you're doing with the newsletter, why pro members should be interested in.
We want our pro members to be able to read the newsletter and be up to speed on everything that we're talking about on a week in, week out basis, to make sure that they're getting all the relevant information that they need to execute their trading plans and their systems on a day in, day out, but a week in, week out basis as well. And so we're making some revisions to the newsletter over the course of the next month or so. We're way excited about it. It's obviously a combination of write-ups and looking at the week that was, talking about the different technical conditions of the market from a multiple time frame perspective, talking about the major market internal indicators such as the 3-month high-low indicator, the fear greed index, volatility index, the RSI, the put-to-call ratio. We like to look at another section would be the economic data, what occurred last week, what is occurring coming up this week, so that our community is fully apprised of not only the technical conversations, the fundamental conversations, the behavioral conversations, everything that we're talking about on a week in, week out basis. And then obviously to go along with that, go through our rankings, what got upgraded, what got downgraded on the week in, week out basis. Had a write-up this week on what is the earnings game, for example, just a little subtopic as we're heading into earnings season. Talked about the blended growth. Then we got into commodity corner and went through all the global commodities to not only go through the rankings of them, but also from a overall technical perspective as well. And you and I and Coach Gino are kind of combining our efforts to really put together a well-rounded newsletter for our community. And so we're hoping the pro members certainly enjoy the revisions that we are making. We're going to be making more revisions, and along with the newsletter, we also put videos on the sector rankings, on Commodity Corner, on Rapid Fire, to give the investors, the position traders, the swing traders, some of those awesome picks as well. So we're very excited about where this newsletter is going, and hopefully the pro members enjoy it. And if you're not a pro member, definitely become one, because this newsletter is going to help you navigate the financial world every single week. So we're excited about it. Hopefully people are enjoying it.
Yeah, I've kind of to myself started referring to it as the Holiday Inn newsletter. Those commercials where the guy or woman is like, yes, let me save your life well, are you a doctor? No, but I stayed at Holiday Inn
I
last
did
night.
stay at the Holiday Inn.
Are
Hey, are
you a
you a financial expert? No, but
financial
I
expert? No, but I read the news,
did
and
read the
seriously,
tackle trading newsletter there. Yeah,
it has that much information where you can literally check out of the market and check into the newsletter, check out the whole week, check into the newsletter, and you're like, oh yeah, I know exactly what's going on, because we're not going to leave anything out if it was important that week.
absolutely.
And last week, we'll talk about the week that's coming up here in a minute. But recapping the week that was, Matt, we saw a little market volatility in different spaces, both to the upside in things like oil and gold, because volatility is not just negativity, right? It's volatility cuts both ways. And markets breaking a little bit, Matt. And there were a couple, like there were three lines of like thought. One was geopolitical. We'll talk about that here in more depth. But the other was kind of a yield story where the economic data, the Fed speak, kind of started making things a little more sensitive to those 10-year Treasury index than they have been for, like, I don't know, 5 months or so. Uh, that sensitivity to yields, that's where I would like to start, Matt, because we saw price action and bond yields, especially in price sensitive areas, react for the first time in a long time. What did you notice this week along those lines?
Well, I think that's one of the major things that we did learn this week. If you're thinking about what did we learn new this week that we did not know last week? Well, last week we were in the middle of a very consistent trend, both on the daily and the weekly timeframes. You've had some separation on that consistency, and the separation we're seeing so far is on the daily chart, not necessarily the weekly chart. And so last week you had every time frame aligned with just bullish analysis. You had some slowing momentum from a short-term daily chart perspective, but for the most part, most time frames were very, very much aligned. The daily chart obviously started showing a little bit of increasing volatility this week, and I think that's the number one thing that we did learn this week is, yeah, we can talk about the labor market news, and we can talk about Kashkari and interest rates, and we can talk about the geopolitical situation with Israel and Hamas and potentially Iran. But however you want to parse that, the number one thing I learned this week that has not been part of the conversation this year was the sensitivity that the market displayed to economic data that we just have not seen in recent history. Even previous Fed announcement, previous Fed speakers, previous labor market data, previous CPI data, even though we've been having that conversation on double dip inflation for the last month and a half, even though we've been having a labor market conversation, it's not like the market was sensitive to it.
In fact, Matt, you would see market cynics out there be like, well, good news, bad news, it doesn't matter. Market just is incorporating it all.
Cynics, non-cynics,
like
traders,
it was just
non-traders, investors, everybody was looking at being like, this market is discounting data. There's no doubt about that. And that changed this.
And that changed this week.
Yes. And specifically, though, that changed specifically on Thursday of this week when you had the double-pronged news items that came in on Thursday, with one, Kashkari, the Fed official that basically stated, due to the improving economic data and quite frankly, the sticky 3% CPI inflationary conversation, that we may not see an interest rate cut this year. You pile on top of that with an Israeli strike on an embassy in Damascus, and then Iran basically stating that they are going to attack Israel. That happened on Thursday, and once again, it's not like we're not familiar with the Israeli, Iranian, Hamas situation. We're literally the 6-month anniversary of that war mark is literally today, and so this has been obviously an ongoing situation, and yet the market had discounted it recently. when you're looking at the Fed officials and the interest rate conversation, Mark, the Fed's been talking about a little bit more hawkish language for the last 2-3 weeks regarding monetary policy. You had multiple Fed officials even before Thursday come out and suggest that the market's not going to get what they expect, which has been obviously the conversation all year long. And yet we didn't see any increasing volatility to that. And so I don't think you can't discount the volatility that we did see, even with the snapback response to the labor market news on Friday. You can't discount the volatility at the top end of a trend. When you violate when you see increasing volatility that violates a short-term trend, that short-term trend oftentimes doesn't just recalibrate and get right back into that consistency, because we got to work through that data. And then when you talk about the economic reports that are coming out this week, I do think the market's in a little bit of a wait and see pattern. And the wait and see is based on two things. You got CPI and PPI this week, and you got the kickstart to the bank's earnings this week. Those are major events that, with the market being now sensitive to incoming data where they had not been sensitive to incoming data, I do think you got to be a little bit cautious going into this week.
Yeah, no, and I want to set the stage for this coming week here in a few minutes. I want to spend a couple minutes on the Fed before we move on. Matt, and I think what you just said there, sums up. It's not like Fed officials have been, Jay Powell has been incredibly dovish, maybe the most dovish of all the Fed officials, to be honest. But it's not like we haven't seen, Fed officials talk their, hey, let's be careful, blah, blah, blah book. But it seemed to be wrapped up. And
literally this week stated they might not lower interest rates. And then Bowman on Friday suggested that they might raise interest rates.
Yeah, and that's what I wanted to talk about. It seems like this week was a 7-minute abs, no 6-minute abs type week, where the rhetoric started getting more and more hawkish during the course of the week. Whereas on Friday, as you just said, Bowman said, we may have to raise interest rates. That's the first time this year a Fed official in any form,
in any regard,
has used those words about, because it's all been a conversation about rate cuts. And I asked you privately, was Bowman out there floating something, or was she freelancing?
It's a very important question,
because it is a very important question.
The messaging that the central bank wants to put out there. And the messaging is certainly, typically Jay Powell will go out there and say something, the market will run with it, and then the Fed officials in their speeches will try to throw some cold water on the topic. And so it's not shocking to see what Powell and the speeches Powell has given lately, both in front of Congress and not in front of Congress, being, I think it would be accurate to describe as dovish. Dovish Jay Powell, I think, would be accurate to describe, especially recently over the last 6 weeks. But I don't think you could say the exact same thing about the Fed officials who signed off on the dot plot, who signed off on everything Jay Powell said and did at the previous Fed meeting. But they're coming out and they're talking it down a little bit. And you've seen that across the board with a lot of Fed officials in the last couple of weeks, try to talk down a little bit of the dovish analysis coming out of Powell. And so you had two moments this week that I feel are very important to kind of dissect. You had Kashkari this week come out and suggest that they may not get interest rate cuts this year. I think that goes with the message that Powell's trying to put out there right now, throwing a little bit of cold water on the rate cut conversation as inflation is coming into to a little bit of stickiness right around that 3%. But I don't think Powell wanted to let the cat out of the bag on the rate hike conversation yet. And so I do think Bowman was kind of freelancing a little bit with her personal opinions a little bit too aggressively there, and did kind of say the quiet part out loud, that if this inflationary situation does not improve and the economy stays where it is without any degree of economic correction, you're going to have to be forced to have a rate hike conversation, quite frankly. And I think that's what Bowman did talk about a little bit. So I don't think Bowman was telegraphed at all. I think she was freelancing. I do think Kashkari doesn't freelance anything. It's all messaging out of Kashkari.
Kashkari every day wakes up and is doing an audition to be the next Fed chairman.
He lives his life for that role.
He is going to be but his
message. God help us all if he is. He's more dovish than anybody on the central bank. I don't care what he says.
Yeah, no, whatever Hawk is.
He is an adopter of quantitative easing.
And he is a deep believer in.
He is a deep believer in modern monetary theory. Deep believer. He is a strategic executor of modern monetary theory. I don't care what he says. Right now, he's saying the right things. Right now, he is. But no, I do believe he has some deep philosophies regarding modern monetary theory, and none of those modern monetary theories are good for consumers around the world.
And as we detail in the newsletter, the economic data that came out this week, the Fed officials are citing that economic data as a reason, Kashkari, other Fed officials, why they have room to work with. Even Jay Powell, in his dovishness, has pointed to strong economic data, giving them time. Jay Powell spoke at Stanford this week, as you know, Matt, and while he didn't really say anything, his tone was just the general dovish. But one of the questioners, it was an interesting little exchange. One of the questioners asked, well, why aren't you going to cut rates, right? Basically, and the premise of his question was, hey, we're venture capitalists out here in this part of the world, and our money is really, really expensive right now. When are you going to give us a cut? When are you going to give us a cut? And Jay Powell, well, he said a couple of things. One, he cited the economic data this week, and then he went out of his way to say, listen, we're going to get inflation down to 2%, not 3%, totally unprompted. It wasn't part of any question that was asked. But he's been listening to the Trading Justice podcast, obviously recently. And
yeah, he has. Chairman Powell, we see you, and we also see that you said the quiet part out loud against that 3%. If 3% was not part of the conversation, why would Chairman Powell say 3%?
To go out of his way yeah.
And again, if it was only people like myself that are central bank hawks and monetary hawks that criticize the central bank when they do things like this, they would never say that, right? But then you had Steve Cohen this week, the owner of the Mets, an investor in Wall Street. He suggested that they were going to have a difficult time achieving that 2% target. And I think with where the debt burden is right now, with where the loose financial conditions are right now, I think it's far more than just people like you and I looking at the economic and the monetary condition right now, suggesting that it's outlandish to suggest that they could achieve a 2% inflationary target. And what I'm talking about is a true 2% inflationary target. I'm not talking about all their adjustments that they may do to the CPI or the PCE report to achieve their 2% number. I'm talking about a legitimate erasing of the inflationary backdrop over the last 3 years. That's very, very difficult to achieve. Even if they wanted to, that would be very difficult to achieve as of right this very second. And so could they achieve it? Yeah. Are they willing to do the Volcker type things that are needed to achieve it? The answer is an unmitigated no, because there's two key factors here playing in the backdrop. And the one is the refinancing issue that they don't want to talk about. They'll talk about everything else, but they do not want to say that out loud. They will cut due to the refinancing issue because they will put the Wall Street and the Treasury and the central bank in front of consumer America. They will absolutely do that. And so you have that refinancing issue in the backdrop, but you also have the election in the backdrop as well. And so I just don't see that. I don't see them having the dedication that would be necessary to do what they need to do to achieve a 2%. I think Steve Cohen said that this week. And quite frankly, I think Jay Powell said that in answering not even answering a question, just off the cuff coming out and suggesting that their target is not 3%. Jay Powell, it's not, whether your target is 3% or 2% is not the point. The point is you are not doing the things right now necessary to achieve that 2%, which means you are going to be forced to adopt a 3% because you will not do what is necessarily economically to achieve that. And so I just wanted to say that out loud. But I did find it quite comical when he said 3% this week.
Yeah, no, and if you want more depth into the significance of 3% and Fed things, check out recent Trading Justice podcast. Over the last 3-4 Trading Justice podcasts, we've went into these very deep. They're very important topics, absolutely worth your time. Check them out because this is an ongoing story that is going to be with us for a while, and it's important knowledge for your investing decisions.
I think inflation is going to be a concern for consumer America for 98% of us for a very long time.
All right, so we got strong economic data this week. Highlight it, Matt, as we and then we'll talk about what's coming this coming week.
Yeah, you had two economic reports that I think were a little bit more important than the other ones this week. Obviously, you had the labor market news come out on Friday, and that was just an absolute standout report. Economically, came in at 303. That's 303,000 jobs. Expectation was 212. Last month was revised downward by 5K jobs from 275 to 270, but a fairly significant upward revision for the January numbers. So, on net, labor strong. Unemployment rate moved down to 3.8%. And the simple reality is the labor market is extremely strong right now. One piece of data that came out from an inflationary perspective, average hourly earnings did come out. That came out right at expectation, 0.3. But the year-over-year numbers went from 4.3% last month down to 4.1%. So wages are outpacing inflation right now. There's no doubt about that. But as wages come down, that is a welcome sight to the central bank, who has been laser focused on wage inflation. So that was a little bit of a positive data point. Is it enough? No, it's not enough, but it is a positive data point for the Fed.
Yeah, I know. And so we got the strong economic backdrop, Matt, and it sets the stage because we are coming into inflation week. Inflation has not been in the back of people's minds. It has been front and center. Fed officials, investors, traders, average Americans, right? Heading into a week where inflationary data comes out, CPI on Wednesday. You and I have both called this the most important data point this year to this point from a narrative standpoint. Explain why.
Well, number one is we are having a double dip inflationary conversation. And whereas we've been having that double dip inflationary conversation for the last 6 weeks or so, finally in the past week, 2 weeks, you've finally seen the Fed officials start to get a little bit concerned about that double dip inflationary situation. In fact, the year-over-year numbers are expected to go up from last month at 3.2% up to 3.4% in the forecast. And so we're already forecasting a bump up in the year-over-year numbers. That's kind of baked into the pie right now. This better not be a miss, Mark. This better not be a miss, because if this is a miss and we get 3.5, 3.6% year-over-year numbers on the CPI report, it's not just the fringe that concerns about inflation nonstop that is going to be laser focused on this. The entire market will be laser focused on this because the entire market's been running hot on rate cuts. And they've been running hot despite the fact that they weren't going to get their 8 cuts, their 7 cuts, their 6 cuts, their 5 cuts, their 4 cuts. Maybe they get their 3. Now it's starting to get, are they even going to get a cut? And so if you get that double dip inflation to get confirmed and most of the market is now laser focused on it, man, that's a lot of price appreciation that has been discounted. That has been discounted in the face of this conversation. And so With the market waking up to volatility last week, and with the market now, focused on the inflationary side of the equation, the CPI report, we know the importance of this report. We know the volatility that can happen around the CPI report. No other report in the last 2 years, it comes close to the volatility that can happen on CPI day. And so is it a scenario where, the most likely scenarios we don't get explosive volatility? Yes, I do believe the most likely scenarios we do not get explosive volatility, but I do believe you have to be a little bit concerned given the fact that the market just last week showed that they are now sensitive to this type of data, as we saw that 1.5% move down in what? I walked away from my computer for like 3 hours on Thursday, Mark. I walked away when the market was a doji at the top end of the price. I came back an hour later and the market is down 1.5. And I was like, what in the world occurred here? And the thing was nothing really occurred. The market woke up to the sensitivity of the inflationary conversation. And so I do think you got to be focused on CPI on Wednesday. Obviously, PPI is going to be an important moment on Thursday. I do believe, and I think this can be, and we talked about this in the newsletter, but I do believe this is the most important day of the year so far in the marketplace is Wednesday.
Yeah, no, it is. And this is the biggest take I have in this podcast is going to come up in the next 1 minute, because there are 3 scenarios. I think it pays to not have an opinion heading into Wednesday from a tactical trading point of view, because you got 3 scenarios. One, if inflation comes out hot and it misses, well, inflation is in the front of the center. You're going to have market volatility. Yields are going to go up.
Don't you have to see downward pressure there? I mean,
yeah,
I would put a minimum 1% down on a hot number.
And I don't think you can rule out anything like from the start to a new correction. Right now, is this going to lead to the next bear market? No, this is election year. You're not going to have a bear market.
That's on a hot number.
Yeah, okay. That's on a hot number.
Oh, yeah, we're not talking bear. We're talking, does the consistency turn into correction?
To turn into a 5-6% correction in that range, right? Type situation, right? So if you have a hot number, it is going to, you got to be careful. If you have a miss, well, that is going to alleviate a lot of worry. Like if you miss to the good side, if inflation comes in, like just
it's weird how you put it, but I'm pretty sure we all understood what you meant there.
Yeah, like if inflation comes in cool, all of a sudden there have been building pressures, right? I think understanding that there are building sensitivities to inflation lets you know that the importance of this.
The market in that scenario where you do come in with a miss in the short term, not the long term. I even if you come
in the short term,
I'm still going to be concerned about double dip inflation.
Oh,
I'm
yeah,
concerned about
I am,
regardless of what the number says this month. I'm concerned about double dip inflation.
But the market could have this sigh of relief that we don't have to deal with it. Right?
We both agree that on a hot number coming in north of 0.3 on the month over month and north of 3.4% on the year over year, we both expect the market to contract at least 1%. Correct?
Yes.
Okay. In the scenario where you come in underneath the number, does that give the market the go sign?
I think you could have a blow off type day to the top side in that scenario. There was a lot of put buying this week, like a lot. And whenever you have a lot of put buying, well, you know what happens if you get a whiff of good news, and that would be
the unwinding of the put buying can create volatility to the top side.
To the top side, and so a miss there. And then if you come in line, which is probably the most likely scenario, right, somewhere in the line, who knows? I think it's kind of still remains there, and I think everything becomes sensitive on stories moving forward, kind of like we saw this week, whereas you saw wider ranges, both to the top and the downside on the daily chart. I
expect 0.3 on the month over month, and I expect 3.3 on the year over year is my expectation. And in that scenario, I see a volatile day ending in a doji.
Yeah, I think that's a good call.
But even in a volatile day that ends in a doji, that could whipsaw short-term trades pretty aggressively. Regardless of what you think, I do think caution is the word going into this week.
Yeah, I just don't think it pays to have a strong opinion until you see the data, right? And as far as like,
especially now that the market's sensitive. Yes.
It's like one of those like I don't mind the straddle though.
I don't mind the leader here.
Just take profit on whatever the big first move is.
Wow.
Yeah, and then of course PPI on Thursday, which has been hotter. It's just the data there has been. We'll see what that brings us. But then Matt, after we get done, and so we're gonna have a pretty set narrative one way or another, even if that narrative is unchanged from where it is today after the PPI and CPI on Wednesday and Thursday. And then we go a
Can I just say one thing before we transition?
Of course.
The one thing I have a hard time seeing on this one, since the majority of the market is now waking up to the inflationary conversation, is the scenario where you get good news, bad news. And I think good news is just good news here. I think bad news is bad news here. And oftentimes we play that game of good news is bad news is good news as it relates to interest rate policy and market direction. But here, a bump up in inflation is bad for the Fed, it's bad for the market, it's bad for consumers.
Yeah,
I think this is a one-to-one type situation.
This one's very straightforward.
Yeah, I think this is a very direct report.
And then we're going to shift narratives for a few weeks as we go several weeks, and there's going to be a inflationary data point in there. There will be a few economic reports, but we're going to shift into earnings discussion, Matt. We're going to just shift into earnings discussion as, after we get this big set of data points. Well, it's earnings season, isn't it? It's earnings season. And Matt, where are our expectations heading into earnings season right now?
Well, do you want to have the earnings conversation now, or do you want to have the commodity conversation now?
I want to have
gold, oil, Bitcoin.
Let's have the earnings conversation now.
Okay. So earnings kicks off this week with the banks. The banks come out on Friday, and specifically, this is always curious to me, but when I was a young trader, it was Alcoa that started earnings season. And
so it was always Alcoa.
Every time Alcoa, came out with earnings season, we were taught to get into the earnings conversation, into the earnings position, to get the earnings hat on, right? And then Alcoa got kicked out of the S&P 500 or the Dow, I can't remember, but maybe both. But they got kicked out, and so it kind of was a who starts earnings season type conversation. A lot of people are like Nike. Nike was the kickstart to earnings season, one of the first components to report, but they're a little bit early in the season to really be the kickstart.
People aren't ready for it. It's too early.
People aren't ready for Nike. They aren't ready for Nike. And so JP Morgan and the traditional kickstart to earnings is JP Morgan and the Friday of the first week of bank earnings. And so that happens this Friday. And so this Friday is the traditional kickstart to earnings. Now, in the traditional kickstart to earnings, you might think we get a lot of names this week, and we do not. Remember, it starts on Friday, which means we don't have a lot on Monday, Tuesday, Wednesday, Thursday. A couple companies I'll talk about here in just 1 second. But what I want to do is I want to kind of talk about the where we're at from a numbers perspective going into earnings season. I talked about this in the Tackle Trading newsletter as well. Mark, the EPS expectation, and I'm going to be tracking these numbers in the newsletter specifically throughout the entire earnings season. And so this is kind of where we're starting. We'll update it through the newsletter and discuss it here on the podcast each week as we kind of get updated numbers. The EPS growth right now is expected to come in at 3.2%. Now, Mark, that's been downward revised from the December 31st number when we ended kind of at the beginning of the quarter, right? We started at a 5.7% EPS growth expectation. Right now, that's down to 3.2%. Now, that's typical to see downward revisions from the beginning of the quarter to the end of the quarter, and I'll talk about that here in a second. Revenue growth. So there's three things we track on on every earnings report, and thus we track these from an overall macro perspective as well. We track EPS growth. We track revenue growth. Revenue growth is expected to come in at 3.5%. As we ended December, the ending of last quarter, that was at 4.4%. So both revenue and EPS expectations have been downgraded throughout the quarter. Once again, that's very, very normal. The ultimate question is not does it get downgraded in the quarter? The ultimate question is, does it get downgraded more than the average or less than the average? I call it the earnings game, by the way. So the first thing we track is EPS. The second thing we track is revenue. The third thing we track is forward-looking guidance. Now, from a valuation perspective, right now the S&P 500 has an average valuation of 20.5. Now, 20.5 is fairly elevated from a valuation perspective. The market was up 10% in the quarter. Was EPS up 10% in the quarter? Probably not. Valuation has went up a little bit. Now, how high is it? The 5-year average is 19, so we're elevated quite aggressively from the 5-year average. We're elevated spectacularly from the 10-year average at 20.5. 10-year average is 17.7. And you might say to yourself, well, Matt, there's not a big difference between 19 and 20 until you see what a 5% correction in the financial market looks like. And you might not say, well, Matt, what's the difference between 20 and 17? Well, that's what we call a standard market correction of 10% in the S&P 500. So those are some pretty big differences in valuation as we do enter into this earnings season. Now, from a guidance perspective, 71% of companies reporting guidance right now, and there's 112 companies reporting guidance. 71% of those companies are reporting downward revisions on their guidance in the quarter. When you look at it, you got 79 downward revisions, you got 33 upward revisions. How does this play historically? Well, historically, we've seen both the number of companies that are reporting guidance get elevated, but also the ratio of negative to positive guidance is also skewed to the bear side as well. 59% of companies usually report guidance to the downside. And so right now we're a little bit elevated on that front as well. And so, Mark, I would say going into earnings season, expectations are fairly high. The price action is up on the quarter. The S&P had a 10% move up in the quarter. You have EPS growth coming in at an expectation of 3.2%. Now, again, 5.7% is the standard number historically. We'll talk about how that looks from a historical perspective. But I would say, based on these numbers and where we're at from a technical perspective in relationship to where we started the quarter to where we ended the quarter, you go look at the S&P 500, for example, Mark, in the quarter, we went from, we'll use the spiders, SPY. Okay, so in the quarter, we went from right around 475 to 518 in the quarter, Mark. That's a pretty sizable 10% upward movement in price. So expectations, I do think, are elevated going into this earnings season. Now, a message on what I call the earnings game, and to understand the number, because whenever you think about a number.
Now, what you are about to explain, Matt, when I first started trading, it would drive me crazy with frustration. I'm like, how do people not see this? And then I started doing a lot more bullish trades and I started rooting for it.
It's the game, the entire.
You just accept it. What you're about to explain is just.
You need to accept it.
You need to accept it. Even if it frustrates you.
This is the game. They do it on economic reports, by the way. They do it on earnings reports. They do it on a lot of things. But it's all about managing expectations in the marketplace. And specifically when it comes to earnings, it's about managing those expectations. And so when I'm talking about the earnings game, I'm talking about the cycle that occurs between the ending of one quarter and the beginning of another quarter, and where we're at the ending of that quarter to where we start the next quarter. And so when you think about it from just this last quarter, once again, the initial projections on this quarter were 5.7% at the ending of December 31st of last year. So the projection for this quarter, Q1 2024, was 5.7%. Now, there are many legitimate reasons a company would lower their expectations on guidance. Obviously a healthy dose of certain things could happen from a company perspective, but typically when you're talking about the earnings game, it's not an individual company. It's from a macro perspective, what all the companies do in the S&P 500. And when you think about the lowering of guidance from 5.7% down to 3.2%, you think, okay, if the entire S&P 500 is going to lower their earnings forecast by that, and again, just to give the context to the 5.7 to the 3.2%, Mark, I'm going to ask you a question. How many billions of dollars does that represent in S&P 500 revenue? Just the expectation of 5.7 down to 3.2%.
A lot.
It's a lot. It's a lot. But how many billions? Just take a guess.
Oh my gosh, I am gonna
I know you have zero clue. I'm putting you on this.
I'm gonna slaughter this. How many billions in dollars? I'm gonna say 110.
110. That's a good guess. That was a good guess. It kind of fits the low bar expectations here. 480.
Yeah, I knew I was gonna be. That was.
That's how many billions of dollars in revenue we're talking.
That surprises me, even like that it's that much, but that's a lot. That almost a half a trillion.
It's close. It's slightly lower than a half.
So just cheating and
lowering the expectation.
Won't say cheating. Just lowering expectation. Half a trillion.
In revenue expectations, yes, that is.
Oh my gosh,
that's a lot. When you think about the size of the numbers, it's like, oh my goodness, this is a major thing. It is. Okay, so we're lowering the expectations here. Now, again, there are many reasons why a company would lower expectations. Apple, for example, would lower expectations based on iPhone sales in China. You could have a lot of companies lower expectations. But lowered expectations usually is because economically we're lowering our total expectations. Once again, an individual company is one thing. When you're talking about it from a net 500 companies in the S&P 500, that's a vastly different thing. And so economically, what happened in the quarter to justify these downward revisions? Well, economically in the quarter, what I will tell you is it doesn't matter what happens economically in the quarter. That's what I will tell you. But if you want to get the context about, wow, we're expecting $484 billion less in earnings this quarter than we did even 3 months ago, you would think the economy is literally just cratering. Well, what's happening? Unemployment has increased from 3.7 to 3.8% in the quarter. Manufacturing data, as represented through the ISM manufacturing report, went from 47 to 50.3, signaling economic expansion and quite healthy economic expansion. The Fed fund, we've talked nonstop about the Fed in the quarter. We're still in interest rate, going through an interest rate cycle, but the Fed fund started the quarter at 5.25%, and guess where it's going to end? 5.25%. Inflation, yes, we're having a conversation on double dip inflation and being sticky right around that 3%. But from net, the beginning of the quarter to right now, inflation has decreased from 3.4 to 3.2%. And so economically, I don't think those numbers justify revising earnings expectations $480 billion downward.
Well, of course not, right?
That's all I'm suggesting. And it's this artificial lowering of the bar here, because this game on earnings is not played at the zero-sum level. It's not if you make money or if you lose money. It's if you beat the expectation. That's what all of this goes on. It goes against the expectation. And as we lower these expectations, all of a sudden, 75% of companies on average beat the EPS expectation. But that 75% is not because we're averaging everything else out at zero. It's because we artificially lower the bar to easily step over it to give all these dudes and gals on Wall Street and running corporate America hefty bonuses, quite frankly. But I wanted to make sure that our community and the listeners of the Trading Justice podcast understand the context of the earnings game. And so I wanted to talk a little bit about the earnings game as we went into the earnings preview here a little bit. Mark, do you have anything to say on the game?
Well, yeah, no, I mean, I think one of the things to understand on the game, well, there's many things, but there's two major things that I use in simple analysis. One, if earnings actually ends up being bad, realize it's against lowered expectations. Yeah. And that can have a significant impact on sentiment, and price action and so forth. And
especially with the market going up 10% in the quarter.
Especially with the market, top of the chart type problems, right? And two, if you hear people on CNBC, and they did this all last quarter, talk about how this was the most amazing earnings season is great. Remember, it is against reduced expectations. That doesn't necessarily mean it was great. Come to Matt. Matt is the most honest earnings and analyst out there in the world. And he would tell you last earnings quarter was what, Matt?
It's average.
Average, right? Like, yeah. So
started out bad. It improved throughout the end, but I at no point did I ever have the liftoff analysis that the market was going through earnings season last quarter.
No, and there have been times that has happened, and it is, I think it's just really, really important. Really, really important. So, yeah, that's just what I wanted to add.
Well, and again, I want to be clear on two things. One, this is very normal. This happens in earnings.
It's the game.
Reports. Yeah. Everything's based on expectations. And number two, when you're talking about the evaluation of performance, the evaluation of performance never starts at zero. It always starts at expectations. And then the savvy analyst out there, they will evaluate those expectations, not based on the performance against expectations, but the average net result against expectations. And what I mean by that is this: when you're looking at the earnings game right now, once again, you've had a decrease in expectations from 5.7% down to 3.2%, which represents $480 billion. How does that look in comparison to historical averages?
Okay.
Is it more than we usually do, or is it less than we usually do? When you look at the 5-year average, the 10-year average, the 15-year average, the 20-year average, okay, and I'm looking at all these different time frames, Mark, the average reduction in earnings expectations is 3.7%.
Over what time frame?
Any time frame.
Okay.
It's like it goes from like 3.7 to 3.9.
I did not know this stat. I stayed at a Holiday Inn last night.
Yeah, it's 3.7 to 3.9% depending on the time frame, but they're all right around that 3.7%. And so we're not actually seeing as much lowering of the bar in this earnings season as we typically do. Now, we're also in a recovering economic condition. So there's a little bit of context there. A lot of times when we're talking about these averages year over year, Mark, we oftentimes, like, for example, how does even 3.2% look historically? Is a 3.2% EPS expectation in a quarter? Is that, and those are year over year numbers, 3.2% year over year. And so is that good historically? No, we average 10% year over year historical numbers. And so we're still in an economic recovering position. And so the 3.7% is based on a lot of good times, a lot of bad times, a lot of not so bad, not so good times. And so it kind of averages out everything. But I would suggest that the bar has been lowered less than normal, what I would suggest. And so we have lowered it, but we have lowered it a little bit less than normal in a earnings expansion environment. The second thing I'll say is this: if we do get a positive number here. So, for example, Mark, if the earnings number ends the quarter at 3.2%, am I going to say this was a good quarter?
That would be a no.
That would be a no, because what I'm going to track is the blended growth number, and that number needs to get above 5% or it's not a good number. We're not going to be based on 3.2%. We're going to be based on the blended growth number. But that's the second thing I'll say. So it does lead to a conclusion that we are lowering the bar less, but given the fact that we're also expecting less, about half as what we usually do historically, I think we're kind of parsing the data. So I would say it's a little bit on average with where the expectations are.
Yeah, no, and it's always fascinating to see the numbers and the themes. And Matt, one of the things also to track, and we got to come up with our own indicator, because you all the time are like making such good calls. Your best call this last earnings season, and anybody that traded on this call made a lot of money, was when you were noticing industrials and other area of the market, you're like, these are just getting bid. These are just getting bid. Doesn't matter what the earnings number is, post earnings.
Caught that one second and a half week of earnings season last.
Yeah, no, and you're like, oh, these are just getting bid. And I mean, you would mention it several times on different programs, and your analysis,
certain themes within the first 2.5 weeks of earnings. You usually catch the most important themes in earnings in the first 2 weeks of earnings.
And your basic analysis was, listen, people are coming in and buying. When people, I'm saying institutions, they are just waiting for the number to not be terrible, and they're buying. And so you would see 10% gap ups on earnings day on numbers that did not warrant 10% gap ups, because people were ready.
Because it was based on the improving economy argument.
Yes, and they just wanted to make sure that company
not just get smoked on earnings, they were getting a bid on earnings.
And you saw that, and it was happening all the time in industrials. And well, industrials had another good quarter. I remember when Apple about 3 quarters ago came out and gapped down, and you were like, this is a market difference. The market is not behaving like it has been. Right. And so, like, that behavior, that price behavior, because the average person, Matt, myself included, cannot tell you whether that earnings was spectacular or not. I'm not an earnings expert. It's not where I've spent my time. And so, like, listening to you here on the podcast, in the halftime report on Tackle Trading's YouTube, present those other themes, right? The other themes that emerge that can give you clues into the market temperament. It's really important, right?
Well, so and see, the thing about it is, you never know what themes are going to emerge.
You have no idea.
You have no clue going into earnings season what themes are going to emerge. What you do see in the first 2 weeks, and the first 2 weeks starts with JP Morgan's. It's not the first 4 days of this week. It starts with JP Morgan, and then you get the first 2 weeks of earnings season from JP Morgan on. But when you're looking at to catch a theme, you basically are looking at the reaction of the stock in regards to how it has performed historically around these conditions. And then you look at it from a macro perspective. I don't know if you can teach that one. Like that one.
No, that is just one of those.
You just got it. You got to read a billion different reports, and we'll obviously update on that throughout the earnings season. So
I'm going to create an indicator based on your tone.
Matt's
the
tone.
Matt tone indicator. It's been pretty freaking good for a long time. So
I like it. Well, the one thing we will be talking about and have a much better understanding of in the next 2 weeks is the financial sector. And specifically, the kickstart of earnings season is all about the banks. It's the regional banks are kind of that second week, but JP Morgan, Citibank, Wells Fargo, Bank of America, Goldman, it's all about the banks that kick off earnings season. So I wanted to spotlight the financial sector very quickly. 50% of the S&P 500 companies reporting earnings in the next 2 weeks are legitimately from the financial space. As you work through earnings season, there's certain weeks that just take hold. First week is bank earnings. Then you get into the Tesla, Taiwan Semiconductor, Netflix week. And so the earnings season has a rhythm to it throughout the sectors. The first one is the financial sector. Now, the financial sector is expected to grow at 0.7% year over year. Once again, we're expecting 3.2% on net. The financial sector is expected to come in at 0.7. That ranks 6th best out of all 11 sectors right now. Now, where does the 0.7 come from? Because there's actually 5 subgroups that we really kind of look at within the financial space. It's not just the banks. You got other aspects of the financial, such as insurance. And insurance is the real good thing happening in the financial space. Insurance companies like Progressive Insurance have been absolutely standouts in the quarter. Obviously, there's been a lot of good things happening in the financial space in the quarter, but insurance certainly does stand out on the back of my head with the price performance and the consistency. Progressive, like I said, has just been a standout. When you're looking at insurance right now, insurance companies in the quarter year over year are expected to grow at a whopping 37%, which is far more than anything else in the financial space. In fact, if you discount just the insurance industry, the sector would grow at it would contract at a 6% decline without insurance companies. That's how important the insurance space is to the banking sector right now. In fact, when you look at just the banking industry, Mark, the banking industry is set to decline in earnings by 18% in earnings. And so if you exclude the banks from the calculation, we don't grow at 0.7 in finance, we grow at a whopping 14.2%. And so when you're looking at the financial space, it's actually fairly easy to understand. Insurance is carrying the space, and what are they carrying? They're carrying the banks. What does that mean? It means the banks, which got carried in the quarter, they need to produce, and they need to produce pretty healthy.
Yeah, no, that's I don't know if that's not low bar expectations on the bank. That's some stuff going on.
Well, the low bar expectation is the decline in what they were last quarter to this quarter, and that certainly has declined as well. But that decline is not going to change the fact that the financial space has been a really good space in the quarter. And so if for example, let's take JP Morgan, for example. JP Morgan in the quarter has went from $170 up to $200. It's up 15% in the quarter. It's outpacing the S&P 500. You're staring down the barrel at a $200 price point. It's went parabolic over the course of the last 6 months, going from 140 all the way up to 200. The elevated expectations is based on this. Why is JP Morgan going up? Is it going up because the banks have been producing such good earnings results? No. It's because they're getting carried based on the economy is improving, the Fed's going to cut interest rates, and insurance in the space has been just an absolute standout. And so, yeah, I do think the banks have to be on radar for a little bit of volatility, given the fact that they are expected to decline 18% from an earnings perspective. They certainly are going to beat that number, but they need to beat that number by that and then some just to justify the 15% of price appreciation they've had in the quarter.
Yeah, no, I mean, so we get our first salvo on Friday, obviously. And, and you've seen this several times too, Matt. Banks can be negative or positive, and I give you a great indication of what's to come because it might just be a banking, right?
It sets the stage. It does set the stage, but we move on quickly. Now, if the banks are doing fantastic, it's really difficult for us to see a difficult earnings season. If the banks start off terrible, you could still recover from that because the banks won't set the stage for when we get into Taiwan Semiconductor Week with Netflix and Tesla there. And so, yeah, the banks are going to set the stage, but I don't think they can I don't think the banks can destroy an earnings season on the initial thing. They can just set the stage. Now, as we start earnings season this week specifically, we only got a few names. On Monday and Tuesday, there's not a lot of names out there. Yeah, in fact, the biggest name on Tuesday is like Tilray, for crying out loud. The biggest name on Wednesday is going to be Delta Airlines. They report earnings before the bell on Wednesday. On Thursday, the biggest name you're going to get is CarMax and Constellation Brands, the liquor company out of the staples space. And then on Friday is when you do get the traditional kickstart, and that's JP Morgan, Wells Fargo, BlackRock, Citibank, and you get Progressive Insurance as well.
Well, listen, I am going to be glued to the halftime report. In all seriousness, it makes me money. Listening to your earnings analysis during earnings season and the halftime report makes me money, finds me trades, gives me, information that I need. And plus, I don't have to do any of the work. So that's always a bonus. That's always a bonus. Now, one thing I do a lot of work on is in commodities. And boy, Matt, you and I have been very pro gold
for a long time.
For a long time, right? And I doubt there is anything that changes in the next, rest of our lifetimes to change that. The macro case is a long one, and it's hard to see it not playing out. This price action, though, is not normal in gold. It's not normal. It's got a lot of people speculating a lot of things. It doesn't shock me. The strength of the move shocks me, right? Mm-hmm. Because you don't see this every day. You don't see this every month. Talk about gold for a second.
Very impressed with gold, but gold, the thing about gold I'm most impressed with is gold is running in the face of things it doesn't typically run in the face of. And that's the dollar and the yield conversation. We talked about yields earlier in the podcast. What are yields doing? They're trying to break out. We haven't talked about
that. Is usually a massive negative for gold.
Massive negative. Dollar hasn't necessarily broken out, but it certainly has a short-term bullish uptrend and some positive signs. S&P 500 has been running for a while now. Yeah, we talked about some volatility increase this previous week, but in general, it's been running fairly hot. So in the last month, yields are up. In the last month, the dollar's up. In the last month, the S&P 500 is up. In the last month, labor market has done well. The GDP report was higher than expected. Economically, we saw an improving condition in the last month to the point where the Fed has a hard time lowering rates because the economy is improving. And yet gold, which usually does not run in the face of a strong economy, that usually does not run in the face of the dollar, that usually does not run in the face of the yields going up, it's running at levels we've never seen.
Yeah,
it's calling things out, and the simple reality and what I've been anchoring against is, regardless of the situation that I just talked about, the economy going up, the S&P 500 going up, yields going up, there is a fundamental belief in gold right now as a protectionary asset class against inflation, and many people, myself included, see this environment as a double dip inflationary environment similar to the mid to late 1970s. And in those environments, you don't sell your gold simply because the dollar or yields or the economy improves in a month. You have a little bit stronger conviction than that. And then you talk about the central banks hoarding gold right now. So you got the central banks hoarding gold. You got Wall Street starting to adopt gold, which Wall Street never adopts gold. And you got a consistency playing out here that we really haven't seen. Now, I will say this, that it is abnormal, obviously, to see gold run like this, but I don't necessarily see a conclusion to this current run. I do believe technically we're stretched here. I look at technically stretched from a variety of different perspectives.
Yeah, you're stretched by any historical standard.
When you look at the weekly chart, the weekly RSI right now is, what's the number, 79? When was the last time the weekly RSI on gold hit 79. I don't even know the answer to
maybe
that.
post-pandemic, like in that little stretch. I'm trying to think.
Yeah, like, it's post-pandemic. No, we got a stretch here on the weekly chart where we got around 87 right before the pandemic. We kind of hit there. So we can get up into about 85 historically, maybe 90 before you get the ultimate conclusions on those weekly charts. But on every one of those weekly conditions, Mark, I'm not sure you can say that those conditions are similar to this condition. And so I do think there's more confidence this time around. On the daily chart, you are stretched currently at 86. Recently, we got right around 95. So you still got a little bit of room, but you're stretched there. When you look at potential average yield, for example, another technical way of assessing overvalued, oversold conditions, the first run in this current trend went from 2,000 up to 2,200. That's a 200-point movement. Then it went from 2,150 up to 2,350, another 200-point movement. So the last time we went through this parabolic nature, it moved 200 points before you went through some consolidation. You're kind of at that level right now. So maybe technically you see some consolidation here, but fundamentally, I could not be more bullish on gold than I am fundamentally.
Yeah, no, and so just tactically how you manage it, constant, adds to a portfolio are always the easiest way, to not overthink things.
Yeah, I don't think it's wise to cover any gold position, but GDX is going to constantly be one of those conversations. Mark, we achieved 30, we achieved 32, now we're at 34. It's been an awesome environment. It's been an uncovered awesome environment. At what point do you start thinking about covering GDX components? Because gold's a different conversation than GDX.
I'm in the money. I got blown out a little bit here, on mine. So I'm looking for re-entries.
Well, a re-entry would be now.
Yeah, like I'm looking for re-entries and find a play. Like once again, I'm not going to overthink it too much in the sense that, oh, I got blown out. Okay, fine. I could have maybe managed that better. Let me go find something to do now on it, right? Like I'm not overthinking the technicals. I guess is the best thing. The lower I get in exposure because of whatever reason, I want exposure. And so I'm just
honestly, bro, the best way to go about this, I think, in this type of condition is just start lobbing naked puts and boomerang it until you get put to it.
Yep. And that's usually how I handle these situations, right?
Well, it's usually how you get a position in the first place in GDX is you lob some naked puts, it gets put to you.
You're like, oh, I don't know what to do. Let me lob a naked put. Now, 31, 32, 33, whatever you decide to do.
Yeah,
right?
that's a different question.
But it's usually let's just call it what it is. When you actually want to own something, lobbing a naked put is the easiest trade management trade you ever make.
If you want to own it, right?
If you want to own it.
The one thing I'll say on GDX is if you are talking about covering a position, or even if you're just looking at where's those next levels of resistance that I have to be concerned about, I don't think it's at 34, although you could always see some degree of consolidation here. But you do have some right here around 35 to 36. 36 top end, 35 low end. That's the zone. And so 35 to 36 is some pretty significant resistance zones for GDX. If you are looking at covering, you probably want to cover 36 or north of 36.
Yeah, and I'm really curious to see how much geopolitical tension was built into price action this week. Here as we start the podcast on Sunday, there were reports out, Matt, that Israel is withdrawing from the southern part to recalibrate their troops. We don't know exactly if those tensions subside. How much geopolitical? Because there's so many things. Inflation. 3% geopolitical war. A debt burden that could cause endgame for the United States as far as what they have to eventually do about that.
Israel pulling back from Gaza change the gold conversation?
create an algorithmic response. That's
you could see an algorithm response given the overextended nature of the
and that's
trend.
basically what I'm asking.
But I would see that as an opportunity to re-energize the trend through a pullback analysis. I would not see that as a real reason gold is pulling back. I don't see that. And by the way, I hope we do see peace. I hope we see more of that, quite frankly. But because I do not want to see an expansion with Iran, and that's obvious.
I would prefer World War III did not happen.
Yeah, I'm not cheering on World War III here.
I'm a fan of life, and
I hope for cooler heads here. But if just from a geopolitical perspective, if Israel does pull back, which as of right now, the news reports are suggesting that they're pulling back from one of the cities where their military occupation has kind of done its job, but they're not pulling back from Gaza. From what I'm reading, it's just one unit is pulling out of one city, but they're not pulling out of Gaza.
But we've seen algos do far more with less.
But there's also talks between Hamas officials and Israeli officials today regarding a potential extended ceasefire. Let's see what that goes through. And you also got the Iranian situation with Iran basically threatening to either hit U.S. Individuals within the Middle East, U.S. outposts in the Middle East, or obviously Israel itself too. So there's a tremendous amount of things happening geopolitically. It will be interesting to see how the market reacts when the futures do open to both the Iranian potential expansion, couple that with the Israeli pulling back out of Gaza a little bit. That's a complicated one to assess, quite frankly. I'd like to see what the price does later on today. My assumption would be, if that is the case, that Israel is pulling back from Gaza a little bit, and if that pulling back from Gaza alleviates the Iranian Hezbollah situation happening in southern Syria, northern Israel right now, would that lead to some degree of corrective analysis within the commodity space in general?
Mm-hmm.
I would certainly think, given the strength of the trends that we are seeing, I do not see that as the conclusion of the trend, but it might be the conclusion of the overextended situation where we get into more, pullback analysis. That's going to be interesting. But as of right now, man, these commodities are on fire, and we're overextended. I would fully expect some degree of consolidation to occur here.
Yeah, well, eventually. I mean, that's just the way. But I think it's important to keep the eye on the prize here, because whatever headline does this, do that, realize that's all short-term noise. Doesn't change the 5, 10, 15, 20, 25-year picture here.
Well, and it also doesn't change the 9 EMA and the 20 SMA and the 50 SMA and all the different support levels that are currently supporting the price underneath the price. So obviously we're going through some really important and big picture situations in the Middle East right now, and there's some ongoing conversations happening that can change the analysis. There's no doubt about that. But for me, news in regards to the market is always going to be looked at through the lens of, did it break anything? Did the news, whether it's positive or negative, did the news break something? If you're dealing with a bearish downtrend and you get some positive news, yes, that happens in downtrends, and they form bearish retracements. But did that bearish retracement break a resistance level and get it into reversal territory? In a bullish uptrend on gold, if some what I would say is positive news impacts gold to the negative, well, the ultimate question is not, did it go down today? Because if it goes down today, it's probably still above the 9 EMA. Did it break the 9 EMA, and did you give up the momentum? And if you broke the 9 EMA, you gave up the momentum, did it go down to the 20 SMA, and did you break the 20 SMA and break bullish retracement analysis? And if it broke bullish retracement analysis, which would occur all the way down to 2240 right now, did it ultimately go into a deeper retracement? We track those things from a technical perspective. The news would be the catalyst to go into a retracement, but we would track those from a pure technical perspective far more than a behavioral geopolitical perspective.
Yeah, and it's going to be, you know, the geopolitical headlines obviously on crude oil, who's had a stellar start to the month as well. You know, you've basically up first week of April. We've absolutely seen geopolitical headlines go back and forth. And if you get a little back and forth, oh, some good news, bad news, oil's probably where you're really going to see that price action this week. If you see a big red candle on Monday on crude oil, it could just be, oh, headlines, let's play with that when you're a little overextended on the daily chart, right? But did it break anything?
Especially with the big green candle on Thursday being Iran was going to hit Israel.
Yeah.
If Iran doesn't hit Israel, let's not be shocked if we see a wipeout red candle to wipe out that big upward movement in price. That would put you into a retracement type situation. I don't think that would top out this trend, though.
No, I think the case for crude oil, and you and I have been very, very steadfast on this, goes beyond geopolitical headlines. Like, it's the geopolitical headlines. We actually do not like them in crude oil. Like, they call, because algos can do some funny stuff with them in the short term, as if that was the only thing going on in crude oil, right?
Yeah.
But it does become the dominant thing.
It'll be really interesting to see how the Israeli-Hamas Iranian situation that's obviously been heating up over the last 48 hours or so, how that impacts the price action on the futures open on Sunday. That's going to be really interesting. But are we talking a high base, or are we talking a pullback here? I don't think it changes the bullish analysis. But again, I'd have to see the price action first.
Yeah, and we'll break that down all week. And what is going to be a busy week on the halftime report, Matt? It's just going to be a busy week. It's just one of those weeks. Earnings season, CPI, geopolitical headlines. Lots to talk about this thing. We'll break it down. What we'll probably not spend much time today talking about is Bitcoin. But it's kind of been boring. There's not a lot to say here. Just kind of waiting for, I'm waiting for a breakout or a deeper pullback, one of the two. And that's just...
it's the same analysis as it was last week, as it was the week before. As of right now, we're tracking a symmetrical triangle on the price action, but symmetrical triangles can be explosive volatility patterns, and they could be really powerful. I'm not the biggest fan of symmetrical triangles. I love more of the ascending, descending type triangles than the cup and handle type triangles, a little bit more than the more aggressive contracting resistance, upward moving support triangles. But that's what we're tracking right now. To me, I 100% agree with you. If you're looking at a trade, you got to be looking at a breakout either of the symmetrical triangle or the top end of resistance. And if you're looking at an ad from a longer term perspective, position trade, invest, you probably need to work lower from here.
Yeah, no, just where we're at. Well, Matt, it's been a busy show. Went a little longer than I anticipated. I will blame the host on that, not on the excellent commentary analysis out of you. But Matt, it's going to be a busy week. It really is. With no shortage of things. Wednesday is the most important narrative report of this year. I thought the NVIDIA earnings was the most important thing up to this point, as far as a singular event. That delivered for the bulls. We'll see what the CPI data does on Wednesday from a narrative standpoint. But there'll be a lot to break down on Wednesday on the halftime report and in the coming days next week. But give us some final thoughts as we close out our show.
If you love the podcast, best way to support the podcast is either give us a like and share on YouTube, or give us a nice little iTunes review. That helps us out there with all those technological algorithms, certainly. But our podcast is brought to you by our sponsor, that is Tackle Trading. Tackle Trading is a financial education company that both Coach Mark and myself are coaches at, and they've been the sponsor of the podcast literally for about 10 years now, I would say. Trading Justice and Tackle Trading got created in the exact same time frame as you indicated earlier this podcast, and it's been a wonderful journey. We love them both. And so if you want to become a part of our amazing community at Tackle Trading, a community of like-minded investors and traders helping each other navigate the financial world together, you can go over there to tackletrading.com and you can hit that Get Started button right there, and you can sign up for a free 15-day free trial of our Tackle Trading Pro product, which is basically everything we do at Tackle Trading. You get access to multiple different webinars every single week, the coaches show, the cash flow club, 5 different traders lounges as well. You get access to that Tackle Trading newsletter that we talked about, the traders reports and the stock and the options report, and many, many, many other things, including a healthy dose of education as well, because we do believe application is important, but education certainly needs to come first when it comes to the priority order of learning how to trade. You educate before you apply. So it's education before application for us at Tackle Trading. And if you want to learn how to trade the markets, invest in the markets, how to put a stop loss on your trade, how to add insurance to your portfolio, how to pretty much do anything of your heart's desire.
Pretty much do anything. Right? We've been around the block for decades now.
And we got some amazing veteran coaches that have been around the block for 15, 20, 25 years. Go over there to Tackle Trading and sign up for that beautiful 15-day free trial. If you don't love it, it doesn't help you navigate, no harm, no foul, but I'm certain you will. So why don't you go ahead and try it?
Yeah, absolutely. Listen, we'll be with you every step of the way, and it's going to be a very important week. It certainly is. But come tune in. Halftime Report, YouTube, Tackle Trading will help navigate the week for you. And then, of course, next week on the Trading Justice podcast. But have a wonderful, wonderful start to your spring season. A couple of weeks now. Enjoy the weather a little bit.